Good afternoon. My name is Lucy Sandell, and I work with the Career Development Team here at the University of Chicago in Hyde Park. I've attached a 3-question survey at the end of the webinar and ask you to complete it to help me continue to provide useful content to alumni and friends. I'm delighted to welcome you to our webinar entitled Home Sweet Home Chicago. Please allow me to introduce today's presenters, Rosaria Becker, Kate Stephens, and Marc Churchill. Rosaria Becker and Kate Stephens, both real estate agents with Berkshire, Hathaway, HomeServices, KoenigRubloff, Realty Group, and both graduates of the University of Chicago Booth School of Business, will share their expertise on the current state of Chicagoland real estate market, including the Western Suburbs and North Shore. They'll cover key metrics by networks, suburb, variables that most impact the value of your home, and their tips for a successful transaction. Marc Churchill with HomeServices Lending will join the conversation to discuss the home buying process from a lender's perspective, including the latest on interest rates, what you really need for a down payment, and his advice on important steps to take before starting your home search. Now let me welcome and hand over the controls to Kate.
Thanks, Lucy, and thanks everyone for being here with us today. We've got a bit of a thunderstorm going on in the background, so if you can't hear me, let me know and I'll try to speak up. So first we're going to take you through the market, a little national overview, but primarily we're going to look at Chicago, the north and west suburbs. Then we'll talk about what impacts property values. Marc's going to talk to us about what's going on right now with interest rates, and then finally we'll take you through the steps that you need to take to get ready to buy a home. Sorry, a little technical difficulties here. So here's the question everyone wants to know the answer to. How's the market? So a quick national overview. This is the S&P CoreLogic Case-Shiller Index that's been tracking pricing in the U.S. for the past 20 years. Right now on a national level, we see that the home pricing index is up 5.9% versus last year. And we're actually on a 31-month high as a nation. That's being driven primarily by the Pacific Northwest, Seattle, Oregon, and then we've also got Denver driving that. In Chicago, we're right in line with that national index. Chicago's pricing was up 5.8% versus a year ago. And what we're seeing driving that pricing is an overall lack of inventory. So for February, average inventory on the market represented 3.7 months worth of sales, whereas the long-term average is usually 6 months. So what that means is the months of inventory is how long it takes for demand to absorb supply, meaning if no more homes go on the market today and in the future, it'll take 3.7 months for demand to absorb supply. Lack of inventory leads to fewer transactions for 2 reasons. First off, we see that people can't afford to trade up as prices increase, and then also people aren't willing to sell because they have nowhere to go. We also see that higher prices and higher interest rates lead to fewer transactions because there's a reduction in the overall purchasing power, the reduction in the number of people who can afford to buy. So the prediction is that prices are going to be forced to level off with the rise in interest rates, but the million-dollar question is when. So now looking just at the Chicago market, and we're going to break this down by neighborhood because really all the different neighborhoods in Chicago, no two are the same. So for Chicago overall, the median price point is $275,000. That includes homes and condos. We see that the change in pricing over last year was 4.6%, and the month inventory is right where we are on the national average at 3.7 months. We are, however, seeing a decline in inventory, so inventory is down 12% versus last year. In Lincoln Park, we're seeing a good appreciation at 3%, but we're not seeing that decline in inventory. And a lot of that is due to the fact that in Lincoln Park, you've got some very high value homes that are taking a lot longer to sell than your typical $500,000 condo. On the near north side, again, we're seeing good growth at 3%, and then again, those limits on inventory. And in the West Loop, this is a bit of an anomaly, but we're seeing that prices and inventory change are flat, but you see that the month's inventory is only 1.4 months. So probably it has the lowest amount of inventory in the city. And this is really just a timing issue right now with new construction. As developers finish their projects, there's an outflux of availability, and all of those units close at the same time. So while there's a lot of new construction going on in the West Loop, and a lot of those new units are under contract, they haven't actually closed yet. So we are seeing a bunch of older inventory on the market, but that's not driving prices up. And then Hyde Park is one of the hottest neighborhoods in the city right now. Primarily as investment. It's a unique area where you'll see that there are $1,000 rentals, but then there are also $2.5 million properties. And whereas people once came and moved, now a lot of people are staying to be near the hospital and the university. Just quickly looking at demand, you see that over a 3-year time period in these neighborhoods that we looked at, the Chicago demand is steadily going up. And then you'll see that from a supply perspective, we really started to see inventory tighten around 2015. And then Rosaria is going to talk to you about the suburbs.
So we chose 4 suburban areas that are just west of the Loop, where I often find buyers are coming to in order to be closer to the work. Typically, they will reverse commute, and coming from the city, the types of things that they're looking for are generally moving from a condo or a townhome into single-family home, looking for a larger space, a place where they could send kids to school, have just a different lifestyle. And as you'll notice, the Hinsdale market will trend significantly higher than some of the other markets that we've seen, LaGrange, Glen Ellen, and Naperville. Average starting price point for single-family homes tends to be closer to $1 million. This is both a combination of attached and detached properties. We don't have quite as big an inventory in the suburbs for condos and townhomes as we do for single-family homes. Each of these communities' price difference is really driven by schools and quality of schools, but also by neighborhoods. So, for example, within the Hinsdale market, you're going to see larger homes, lot sizes tend to be a little bit bigger, and there's going to be more variety. LaGrange tends to have narrower lots and older homes, so it's a good starting point for new home buyers. The specifics of the individual communities are also driven by the school district. Hinsdale, with District 181, is highly sought after. It's generally ranked higher, but the other neighborhoods as well will have really strong school districts, parks, etc. Naperville is a little bit different from the rest in that it really consists more of subdivisions, where the other neighborhoods are generally walkable. Naperville tends to be less so unless you're in the downtown area and right in the historic district. Generally, you're going to be driving in a lot of the places. It's composed of mostly subdivision, the older subdivisions being to the north of the Naperville area, and then as you proceed south, you'll notice larger homes and much newer subdivisions. In terms of the trends you're seeing, the demand in the other communities, you'll see the supply in Hinsdale tends to be higher. Relatively speaking to the others, you see in the 4-month range for LaGrange, Naperville, and Glen Ellen, Hinsdale having a higher inventory. A lot of this is due to the fact that it's a much higher starting price point for homes. We also notice in those communities there's been a shift to newer construction. So we have some of the older homes in town, really terrific architecture, unique in its own right, but we're also finding that buyer demand seems to be more for the open floor plan that they're coming from in the city, so we tend to see some of those properties tend to linger on the market just a little bit longer. And then you can see the same in terms of demand. The price point that you're noticing in Hinsdale being at 800 hasn't changed an awful lot from the prior year, but you are noticing in Glen Ellen a little bit of a decrease in pricing, with the other two markets, LaGrange especially showing a higher increase just because the price point is lower and it's a bit more affordable for folks, and inventory is less. And that's reflected in the next slide as well. We have far less inventory in Glen Ellen and LaGrange and Naperville than we do in the Hinsdale market. The North Shore is a little bit different, both aesthetically in terms of how the neighborhoods are composed. They tend to benefit from having proximity to the lake. So if you are leaving the city and concerned about city life, some folks will merge up to the North Shore just because it mimics a little bit some of the neighborhoods that we see in the city. And the things to point out there is in terms of Winnetka, we are noticing just a slight increase in pricing, but some of the other neighborhoods are staying relatively flat, with Lake Forest really showing the least amount of change in terms of price. And you can see from the inventory availability, Winnetka and Glencoe still have a healthy inventory, but Lake Forest by far exceeds the rest. We haven't seen a whole lot of recovery yet, and there's quite a few properties that tend to be larger, tend to be higher priced, and in some cases haven't been updated to the standards and wants of today's younger buyers in terms of finishes and configuration of space. And you'll see the rest as well. Same things that drive folks to the western suburbs will drive them to the North Shore: the quality of the schools, the access to parks, flexibility to get to the airports. Many executives that live on the North Shore travel quite frequently, so being able to access O'Hare is important to them, and just overall quality of life. And you can see the same in the slide relative to demand, Winnetka being among the highest priced on the North Shore of the North Shore suburbs that we've selected.
And so obviously Rosaria and I couldn't provide you with information on all Chicago neighborhoods and all suburban markets, but if you have any questions, our contact information is in the presentation. So please feel free to reach out and we can put together any information on any neighborhood or town that you would like. So next up in property valuation, we've talked about inventory levels impacting the value of the home you buy, but what else is impacting market value? So you've all heard that the #1 driver of value is location. And to be more specific, that's access to public transportation, walk scores, school districts, as Rosaria mentioned, proximity to urban centers, quality of life. So it really does boil down to location, location, location. An example I like to use is, I'm biased because that's where I live, but I think the West Loop is one of the hottest markets in the city right now, because it has all of these location variables going for it right now. From a public transportation standpoint, you've got the Blue and the Green Line, you've got Ogilvy and Union Station, all within walking distance. A lot of people who live in the West Loop don't even need cars because you can walk to the grocery stores, restaurants, coffee shops, Target, anything. You can basically buy whatever you need and walk there. It also happens to be the #1 ranked school district in the city. So, you know, young professionals, young families are moving there. And then obviously there's proximity to the Loop and then proximity to highways.
The same things apply to property values that are in the western suburbs, location is still important. One of the things I find as buyers migrate from the city to the suburbs is walkability is still very important to them, because the transition itself is certainly marking a change in lifestyle and a milestone for them, and being able to walk to town is important. The walkability is a little bit different in the suburbs than it is in the city, but certainly those areas that are very walkable, like LaGrange and Hinsdale, for example, are preferred to folks that are still looking to replicate that same lifestyle. When you migrate further out into the suburban areas, for example, the interest there is more in terms of the access to the public transportation and how easily can you drive to the train to be able to get back to the city, or access to major highways. So walkability is still important in the suburbs as well. And as Kate mentioned, schools are really important as well, because they do vary from one suburb to the next. So this is the Illinois Standard Report Card. It's a very academic look at different schools. It's accessible to everybody. You just need to plug in the name of the school, and it really gives you some really important data about the school in your neighborhood. And as you're looking at different neighborhoods and even looking within districts, it's really important, if school is one of your primary reasons for moving, is that you take a look at the individual schools that your child is going to be attending over the next 8 to 12 years, and determine if that's a good fit for them, but look at it more in terms of the individual school level, and then of course district-wide. It's a really terrific way to compare one school to the next, because it does provide the same data across the board.
We touched upon this a bit for urban centers, but obviously, you know, when you're looking at location, you want to, that ease of transportation is going to be one of your biggest factors. So whether you're in the West Loop or River North and you can hop on the L, or you can walk to work or grab a lift, or whether you are working in one of the suburbs and you can hop on the highway or hop on the Metro. But so this proximity to urban centers, whether it's a hospital, the universities, is going to be one of the most important variables in determining your price.
And in the suburbs, the urban centers are just a little bit different, because we do have major industries out west in the Naperville area. That was typically one of the areas that a lot of executives came to, just because of the presence of Amoco for a long time. But there are other major work centers out there as well, and that for many people is also a deciding factor of how far west they will go.
And then quality of life is obviously a more subjective variable. It's going to be different for everybody, but in terms of amenities, driving price up in your building for a condo would be different building amenities, like the doorman, a gym, a pool, and then also your neighborhood amenities. Like some towns have snow removal, some make it homeowner's responsibility. Lake Forest is known for having one of the greatest libraries in the suburbs. And then as we talked about, schools. So these public resources are going to greatly impact your quality of life. Also recreation centers, parks, green space, parking, and then, as we mentioned, time commuting to and from work.
And all of these apply to the suburbs as well. For example, park districts and being able to access different programs for kids is really important out in the suburbs. Being able to decide for yourself, if you're coming from the city, sometimes the buyers will go the opposite route. If they were in a dense neighborhood, sometimes they'll choose to live on a bigger lot size just because they are looking for more space. They're looking for green spaces, and classroom sizes do vary quite a bit. In the suburban community, many of the schools have on average 20 to 22 students per class, whereas in the city it can vary as well. So the quality of life and what's driving you to make a home purchase, whether it's schools or commute or space. Those are all important deciding factors on how you choose your community, in addition to how much then you are going to be able to afford.
And then finally, after inventory and location, home-specific factors are going to greatly impact the value of your purchase. But in a lot of cases, these factors can be, kind of the low-hanging fruit for buyers. These are the things that you can change about the home, and these are what you can change to improve value in your home. Obviously you can't change the age, but you can change the condition, and you can make improvements that will increase the value of your home. Rosaria and I always joke that buyers today like everything to be black, white, and gray, and there's that open floor plan that younger buyers are looking for. Those are all changes, so if you find an older home that might not have the finishes you like, you can always change that down the road. But one thing while we're talking about what's inside the house, I always like to point out Zestimates, and specifically that Zillow has never been in your house. Zillow's never been in any of the houses in the neighborhood. So they are basing their numbers, their Zestimate, off of recorded deed information. So this is an example from Lincoln Park. 1932 North Burling Street is one of the most expensive properties on the market right now in the city. It's listed at $50 million, but Zillow's Zestimate prices it at just under $5.5 million. So that would be a deal, definitely. And now Marc's going to take over.
Good afternoon. I'll be speaking to the economy of housing, specifically residential mortgage financing. Housing continues to be one of the most important assets a consumer will ever have. There was a quote from FDR, and he said, real estate cannot be lost or stolen, nor can it be carried away. Purchased with common sense, paid for in full, and managed with reasonable care, it is about the safest investment in the world. A more recent quote from Warren Buffett of Berkshire Hathaway, who has continued to acquire real estate brokerages as well as other home services companies across the country in the past 5 to 7 years, is that real estate was used to build wealth 100 years ago, and it'll be used to build wealth 100 years from today. Some economic variables that we'll look at today, beginning with interest rates. We're currently still experiencing near historic lows. I've personally been in the real estate market when the 30-year fix was above 9% and when it's been near 3% and everything in between. And people were actively buying real estate during all of these time frames. Today, the 30-year fixed is trading at approximately 3.875. The 15-year fixed is closer to 3.25%, and the ARMs, or adjustable rate mortgages, are in the low to mid threes. In the period from 2008 to 2015, the Fed increased rates only once. In the past 120 days, the Fed has hiked rates twice, with predictions of an additional 3 raises in this calendar year. Mortgage products. No doc, no longer. The exotic loan programs that you may have seen portrayed in The Big Short have disappeared and will most likely not return anytime soon. The landscape of mortgage products today is made up of fixed rates and adjustable rate mortgage products primarily. Limited doc, subprime loans, balloons, and higher risk loan programs are a thing of the past. They've been eliminated in order to protect the consumer, the lending institutions, and our economy as a whole. The most popular products today are the 30-year fixed and the 7-year adjustable rate mortgage. When we talk about economic health and what drives mortgage interest rates, we can look at a few factors. Economic growth, consumer spending, and the demand on money supply. Inflation. Increasing inflation puts upward pressure on market interest rates. The Fed funds rate, short-term rates that banks charge each other to borrow money. This rate traditionally tracks 300 basis points or 3% below the prime rate. The housing market, housing starts, construction numbers, and supply and demand and inventory. And then lastly, the 10-year Treasury bond and mortgage-backed securities, estimates on where the long-term interest rates are headed. We've also traditionally seen foreign events, such as the recent airstrikes in Syria, drive mortgage interest rates down as bonds rally as a result of this type of activity. We've typically seen an immediate shift of market investments to more conservative vehicles at these times in the past. The recent events did not prompt bonds to rally or further support the fact that we're in an upwardly trending rate environment. Some government policies in play. The new administration has discussed loosening up the lending guidelines and deregulation. And while the exotic programs that used to exist before the financial crisis of approximately 10 years ago, those programs will most likely never come back. The process may become more streamlined to stimulate more volume and have a ripple effect on all related industries to housing. The proposed ideas of eliminating mortgage interest tax or tax deduction on primary residence is unlikely to change under any administration. In this graph, you'll see over the last 12 months, approximately, rates have gone up nearly 75 basis points or 0.75%. We saw a 0.5% increase in the 24 hours surrounding the election in November, and then another 0.25% when the Fed hiked interest rates in mid-December of 2016. In the next slide, you'll see an analysis of how rates have performed over the past 4 decades. Perhaps some of you on this call were very excited in the early 80s when rates came all the way down to where you could take advantage of 12% on your home, but the majority of listeners today probably only are familiar with the mortgage interest rates in the current artificial protective range that we've seen in the recent past. While I've personally never predicted interest rates, even though I get the question a lot from my clients, what would you do, what are rates going to do in the next 30 or 60, 90 days before we close, there are some entities that do predict interest rates. Some of those are Fannie Mae, MBA, or the Mortgage Bankers Association, NAR, the National Association of Realtors. They generally put out a 4-quarter prediction, and I've never put much stock in these predictions because they often speak to increasing interest rates, which have never seemed to play out in the last decade. But much like our beloved Cubs last year, this certainly seems like this may be the year for rates to finally go up. Getting ready to buy. You can't get pre-approved too early, but you certainly can wait too long. There's no negative impact to having your credit report ran, as the credit bureaus have installed safeguards to allow you to shop for mortgage lenders. In addition, a pre-approval can provide you with vital information on mortgage programs, customary costs in the market that you're looking to buy, realistic time frame expectations, and pitfalls to avoid when attempting to secure a mortgage. You're paying a mortgage regardless of whether you buy a home or you rent. You're either paying your own mortgage and taking advantage of the tax benefits and building equity, or you're paying your landlord's mortgage and helping them build equity and wealth. Here you'll see a simple analysis of a standard rent spread out over 3 years, and then also the breakdown of what a $375,000 purchase might look like with 20% down. As you'll see, the rent and the monthly mortgage amount is the same, but what we don't show here is the tax deductibility that would come along with a $375,000 purchase, as well as the appreciation that you'll gain. Here you'll see the difference between the average down payment between first-time home buyers and repeat buyers. This also speaks to the appreciation and equity that you'll build after you purchase your first home or second home. You can't necessarily believe the media telling you that you need 20% as a down payment. The difference between a 5% down payment and a 20% down payment is generally maybe a 0.25% in interest rate. Pre-approval. Pre-approval versus pre-qualification. A pre-qualification is simply a phone or an in-person conversation. There's no credit check or validation on income or assets. This process carries little or no weight in our marketplace as it's not factually based or verified. A proper pre-approval fully vets all your documentation. We review your 3-bureau credit report as well as run the scenario through Fannie Mae or Freddie Mac's automated underwriting engine. There are multiple ways to get pre-approved, face-to-face, over the phone, or through an online application tool. If someone has the proper documentation available, a pre-approval can take less than 1 hour. The rule of 2 is in play when it comes to documentation on getting a pre-approval or submitting a loan application. Basically, you need your 2 most recent pay stubs, the last 2 years of your recent tax information, and the last 2 months of your asset information, checking, savings, 401k, brokerage accounts. Most people have access to those through the internet or on their computer. From a timeline standpoint, basically the standard timeline is approximately 30 days to satisfy your mortgage contingency, which is a date by which you need to show that you have a written mortgage approval or commitment letter. And then usually closing takes place from 30 to 60 days after the contract's been accepted by all parties. We can certainly move faster if necessary and if the situation calls for it. I'll now turn it back over to Rosaria.
So there are a number of professionals that are involved in ensuring a successful transaction that you will interface with in addition to your lender and your realtor. One important player is your attorney. Generally, attorneys that are proficient in real estate are very familiar with not only the contracts but various real estate laws, and they certainly help to move the transaction along very efficiently. That doesn't mean that you can't hire an attorney that is not doing other things as well, but generally it's best to work with somebody whose expertise is in the field of real estate. They will get involved once an offer is accepted by both the buyer and the seller and continue through until the transaction is closed, negotiating any terms that may change in the contract and certainly negotiating items that may come up from a professional inspection. Inspectors are also important to the process. When you make an offer on a home, you're generally taking a look at what you can see, the condition of the roof, the windows, how does the house appear to you, what is your realtor suggesting for similar homes in the area, and then you put the offer in. But it's not until an inspector comes in and does a thorough review of all the mechanicals, the actual functioning of the home, that you're able to see whether or not the home has any issues. And this is your way of ensuring that your purchase is secure. The MRAD contract allows you 5 business days to engage in an inspection, and then should anything result from that you feel is not acceptable, you as the buyer are protected and can walk away. The appraisers are also very important in the process in that they will help the bank in their process in determining the value of the home relative to other similar homes. Typically, they'll work within a 1-mile radius or smaller and within the last 6 months. And generally, your realtor will have assisted you in the same type of exercise in determining what a fair value is for the home that you're considering to purchase.
And then finally, why use a realtor? Your realtor is going to be your advisor, your negotiator, and your facilitator in what may be one of the most expensive purchases you make ever. As an advisor, your agent's going to be an expert in the neighborhoods that you're looking to purchase in. So they're going to know the amenities of the neighborhood. They're going to know what the schools are like. They most likely have been in the house that you're looking at. They've been in the houses that are comparable properties. They're going to be able to tell you when a house is overpriced or underpriced. So the role of the realtor is to negotiate on your behalf. That is not just at the purchase and on the initial contract, but also as you move through the attorney review and inspection period. They may also negotiate inspection items that come up, items that come up during attorney review, maybe from the condo association, and they're going to be working in your best interest. And then finally, they facilitate the deal. So it's not over once you send that contract, put a price in it, and agree to the final price and closing date. They're going to be working with you with your inspector, with the appraiser, with your attorney to make sure, and with your lender to make sure that you have a smooth closing and that you close on time. So that is our presentation for you. And at this point, we'll move over to the questions and answers.
Great. Can you hear me?
Yeah.
Perfect. We do have questions. One is, how do you expect home prices in Chicago to be affected over the next 3 to 5 years by the severe pension underfunding? Will property taxes have to be dramatically increased to cover the shortfall?
So I'll speak to this. I mean, I wish we had a crystal ball. The pension underfunding, our schools, our trains, these are all things that we need to figure out. And I know that, I mean, I hope I can say that our officials in government have been working hard at coming to a resolution. I can say that I have my children in public schools. I live in the city. I'm moving to another home in the city because it's right for me and my family. And I know that a lot of people are continuing to live within the city. These are all, you know, issues that we have to work out. It's certainly not going to happen overnight. We did just see a very large tax increase in 2015. It was between 20 and 25% for homeowners. We can't continue to increase taxes at that rate. And as far as I've heard, there has not been future plans to do another tax hike like that. When you look at the city compared to the suburbs, we have significantly lower taxes than at least the North Shore. Rosaria can talk to
the taxes in the suburbs will vary a lot by township. So parts of the suburbs like that I mentioned before, for example, LaGrange reports into Cook County, parts of Hinsdale report to Cook, others report to DuPage, but the township is really what affects the tax rate. I would say that there's sensitivity not just in Chicago but throughout the state and the counties relative to infrastructure challenges that I think our state is having right now. But I am encouraged to see so many large corporate centers that are moving to Chicago that should have a positive impact overall on the city. McDonald's, for example, has been a mainstay in the Oak Brook area for many, many years, and it was surprising to hear that they were moving their entire campus to Chicago because it's been such a significant presence in Oak Brook. And I know that's really to drive a lot of the younger employees to be closer to where they live and where they work. So hopefully those types of arrangements that have been made to move these large work centers to the city should longer term benefit Chicago, but there's a lot of policy that we really can't control as agents, realtors, or mortgage lenders. We're basically going to need to follow suit with what types of things they implement. Any other questions?
Oh, yes, sorry. I just wanted to make sure you were finished before I went to the next one. This is interesting because I experienced this myself. How is pre-approval impacted if you're not a U.S. citizen?
Well, that's a great question. So there are certainly ways to secure mortgage financing not being a U.S. citizen. Some of the banks, so our company, the company I work for, is technically a correspondent lender. What that means is that we will fund with our own money, HomeServices Lending money, and then we'll move that money to another wholesale lender. That may be a JP Morgan Chase, or it might be a Wells Fargo or a U.S. bank. And each of them have their own guidelines as far as non-U.S. citizens. Some of them won't even consider an applicant unless they have 2 years of federally filed U.S. tax returns. Some of them need residency requirements. But in general, if somebody moves here, whether it's a work visa or a student visa, and there are different classifications of both, if they can establish credit here, and if they can get money into a U.S. bank, and if they can show residency generally for 24 months, then it's viewed at by the lending world in very similar fashion than a U.S. citizen. So the 24 months seems to be a very important marker for a lot of banks and lenders when it comes to residential mortgages. So that's what we see.
Great. Oh, somebody asked, they missed part of it. Yes, we're recording it, so you will have access to all the slides and all the great information that's been given. Next question. Mark, you talked about deregulation that went on in the past and how there was tightening up to protect not only the buyers but also the mortgage companies. I'm sure most mortgage companies didn't want to have like a bazillion pieces of inventory on their books either. What do you think? Like, I know that nobody has a crystal ball. I'm not sure if Kate said that or Rosario did, but I like that term. But what do you think the deregulation might look like?
Yeah, great question. So when I entered into the marketplace 20 years, it was very much a full documentation world with mortgage, meaning that you had to show documentation on every aspect of the credit profile. And then in the early 2000s, it moved to one of a very limited documentation world based on credit score. That did not work out at all. So those days will not return. But what I do think will happen behind the scenes, what the consumer does not see, is all of the hurdles that mortgage companies need to jump through to satisfy Fannie Mae and Freddie Mac and the government's presence in our world. I think there'll be a loosening up on those. It will never go back to if your credit score is above 760, you won't have to provide tax returns or pay stubs. But I think behind the scenes, the process will be easier, which will afford us to possibly close transactions sooner. And I think from the outside, a lot of people or consumers might feel that, well, if I have a 20% or a 30% down payment, why do they need all of this? I don't think the documentation is going to change tremendously on what has to be provided by the consumer, but I think that the hurdles that the mortgage lenders need to go through to get people to the closing table either sooner or easier will happen to stimulate more volume and more home growth, because that has to continue to happen as an economy as a whole, because that's one of the main drivers that by all means interest rates shouldn't be in the threes right now with where other indexes are at, but I think that's a main reason why interest rates have to stay low to continue to support the economy and make sure that what has happened doesn't return.
Great, thanks. The next question comes from someone who says they're a freelancer and they've earned a very small salary and has had variable 1099 income over the last 3 years. The income has varied from $30K to $150K. What would they expect when going in for a mortgage? Is it relevant to have a good deal of savings?
Yeah, that's a great question in a scenario that I encounter a lot. The way that the mortgage world looks at 1099 or self-employed buyers or borrowers is in this respect. If year after year income is increasing, they'll take a 24-month average. For example, if somebody made $80,000 and then the next year they made $100,000, they'll take 180 and divide by 24, and that's what they'll use for a gross monthly income to qualify to debt to income ratios, which generally you want to keep between 35 and 43% of your gross monthly income to qualify for a mortgage. The front ratio being just simply the housing payment divided by the gross monthly income, and then the back ratio would be the housing payment plus all your additional debt, car loans, student loans, credit card payments, minimum credit card payments. But if your income is decreasing or variable, as you referenced, if you made $100,000 and then you made $80,000 the next year, they'll take $80,000 and divide that by 12. Now, if there's a huge disparity, kind of like what we had talked about in this scenario, they're going to be a little bit more skeptical and they're going to need to know a little bit more about the scenario. But a minimum of 2 years in some kind of history, and when I say history, I mean federally filed tax returns, showing not only maybe what a 1099 shows, but also what the write-offs are. Because the 1099 really doesn't show the whole story. The federally filed 1040s and the adjusted gross income is what any lender is going to go off of to qualify. But it's a great question. 1099 employees can certainly get mortgages just as easy as W-2 employees working for corporations. It's just they take maybe a larger snapshot, and if there's disparity in income, they need to know what's going on, and then also where they're trending in the current year. Great
Great,
question.
thanks. How are retired people qualify for a mortgage or short-term loan?
I'm so glad that somebody asked this. While I did reference that exotic, we used to call them Ninas. No income, no asset, no, if you came in and fogged a mirror, you could walk out with a bag full of money. Now, it wasn't maybe that easy, but it seemed like it at times. Now, those programs are not going to come back, but there are some programs, I wouldn't call them exotic, because they're based on asset. There's programs for retired people perfectly fit into these programs. They're called asset dissipation or asset depletion. And the way this works is traditionally, let's say a 70-year-old person who might be out of the workforce and maybe they don't have a pension, but they've acquired a great deal of assets. We can derive income based on the amount of assets they have, where those assets are put, their age, and then they usually spread that out over a 60-month or a 5-year period. So depending on their down payment, their credit score, these programs are perfect for somebody who might not currently be working but also has a strong asset base. There are also other programs for people over 62 called reverse mortgages. Now, that might not be the best option for somebody who has assets in the bank, but somebody whose biggest asset is the home that they live in and they don't want to relocate later in life, that might be a decent option for them. But working with their financial planner and then a mortgage professional would definitely be able to choose a path that works best for their scenario. It's a great question. I'm so glad somebody brought that up because it's a really neat program for people that are a little bit older and maybe don't have steady employment.
I'm going to jump on your reverse mortgage thing. Sorry, we're still waiting for more questions, so it seems like it's okay to do that. So somebody can apply for a reverse mortgage and move. I don't know. I've only heard the commercials where some celebrity tells us how wonderful a reverse mortgage is, and it might be. But I always thought that it was just to stay in your own home. It wasn't to move to another one.
That's exactly correct. So the reverse mortgage is just to be able to stay in the home that you currently own. And then basically they work out a formula based on your age and expectancy tables. And then it allows you to not have to relocate. Yep. Reverse mortgage got a little bit of a black eye 10 years ago or 15 years ago when it was rolled out. I think it's much more regulated today. I don't believe it's a great option, but for some people it's their only option. So it allows them the security of staying into their golden years into the home that they've been in for maybe 20 or 30 or 40 years.
Great. Now one question about going back to your house. If you're trying to sell your home, you hear all kinds of things about, oh, well, you should revamp your kitchen, or you should revamp your bathrooms, or you should revamp both your kitchen and your bathrooms. What would give you your biggest bang for your buck, and what would you say? People don't really care about that so much. Don't focus on the basement so much. Or what do you think?
It's always probably one of the hardest, or we have one of the most delicate parts of our job when we walk into someone's house and have to make suggestions for things that they can change. And Rosaria is a designer, so she is definitely a big help. And I'm in the process of getting my home ready to sell right now. So I'll just tell you what I personally would do. I lived in my home for 5 years, and I made a few updates. I updated some of the bathrooms. I updated the kitchen. I did not, gut anything. I did not do huge renovations. It's all the changes that you need to do to sell are really more of the aesthetic. I mentioned before black, white, and gray. I think a fresh coat of paint makes everything look so much nicer. If you've got carpeting, new carpet is going to go a long way. If you have hardwood floors, assess the condition. So sanding and refinishing your floors is not a huge expense, and especially today where buyers want darker floors, I think that also can do, staining your floors a darker color can do a lot to make your home seem much more updated. Quick fixes also can be cabinet colors. If you have a lighter cabinet finish, as again, black, white, and gray. So I don't want to offend anybody with your choices of decor, but the millennials who are out looking generally want like a white kitchen. So you can have your cabinet painted white. It's a very cost-effective way to paint over what you currently have. And then other things like replacing countertops in the bathrooms or the kitchen might be another inexpensive way to increase value. Like for example, I'm changing out a shower door because it's incredibly dated shower, and I've made other updates to the bathroom that make the bathroom look more expensive. So it's just this one shower door is, I think, kind of dating the entire bathroom.
I think when you also look at the changes to make is deciding how big a leap it is for your particular home relative to the other homes that are in your marketplace. So let's say, for example, that your floor plan works really great, but it's not necessarily painted the most neutral color, or the cabinets are in really great shape, but it's just a matter of maybe swapping out some of the other finishes like door handles and counters and maybe sometimes even faucets. Those are pretty quick wins. When I work with sellers and we talk about what things to change, the one thing I don't do is promise them that, if they invest so much money that it's exactly what, it's gonna return, in tenfold or anything like that. You want to compare your home relative to the ones on the market and see how fast the other ones are selling and what they look like. If there are things in the home that can't be changed, for example, you're not going to knock down a wall to make a big open floor plan. Sometimes you can adjust certain things, but it's always better to think about whether making a price change would be better for you, depending on what your own time commitment is in terms of getting your home sold, or what your other long-term goals may be. But I think all the things that Kate mentioned are important. The minute you decide to sell your home, it doesn't matter what you like. It's about making it likable to the masses. And if you make your home so specific that it only appeals to a handful of buyers, that's going to be a harder sell than if you try to adjust your home so that it appeals to the most number of buyers. And again, it's not necessarily what you like. It's making it available to what most people are seeing as likable. But the other thing I will say too that I think is important is there seems to be this general shift in opinion that open is always better than walls, or open is, everybody has to be open. I think longer term, one of the things to think about is be open to the possibility that maybe something isn't, as a home buyer, exactly the way you envision it. But that doesn't mean it's horrible either. Walls are not a bad thing. They protect you from sound. They provide privacy. There's a lot of benefit to that. And I know there's a stronger push to everybody living in one space. But as your family grows and changes, one of the things that also happens is that you're not necessarily all going to be in the same space together. So be open to possibilities that may not be reflective of what the media is telling us is appropriate, but may be very suitable for your family.
One more thing, I would also say, go through your home with, a notebook, maybe take some pictures of any of the little things that need to be fixed or touched up. Make sure you take care of the little things, because if buyers are walking through, they're going to notice the little things, and if there are a lot of little things, they're going to wonder about the bigger things. And then with the bigger things, make sure that you have everything fixed. I had sellers who had a leak in their garage ceiling. Well, they took care of the leak, but then they kept the big water spot the big water stain on the ceiling and didn't want to paint over it. I mean, those are the things that, you know, an inspector is going to point that out if the buyers don't notice it themselves. So just make sure that, like, the little things are fixed.
Great. On that note, this is perfect timing because this is when I always hope to end, to give everybody a little bit of chance to run back to their desks if they have to, or shut down their computers, or shut down this part. I want to thank everyone for participating today. A very special thank you to Kate, Rosaria, and Marc for this informative and I thought very fun, interesting presentation. It wasn't exactly what I was expecting, and I think that's always a good thing, because if I think it should be something, tends to be better if it's not what I expect. So I really enjoyed it, and I want to thank you so much. I also want to let everyone know that, surprise, surprise, we have another webinar tomorrow. This one is on cybersecurity, which I think is really a cool topic as well, and it's entitled "The Tech Voice You Should Be Following." As a reminder, you're going to receive an email in the next couple of days, perhaps next week, sorry if it takes a little bit longer, with a link to the recording. And we've got the follow-up survey on the screen that's going to pop up when we're done. And if you're curious to know what's going to happen in May we're going to have 2 webinars. One on the informational interview. So I've got a colleague from Career Advancement who does talks about the informational interview all the time on campus. So she's going to be presenting for us in early May, and then later in May we're going to have an alumna who wrote a book called Master the Interview, and she's going to be talking about the interview itself. So I hope you can join us for most, if not all of them. And if you can't, but you're interested, please just sign up so that I know that you're interested, and then I can send you the link to the recordings afterwards. Again, thank you so much, Kate, Rosaria, and Marc. I really enjoyed it. It was so much better than I thought it was going to be. It was no, and not because I thought it was going to be bad. I just thought I didn't really know what to expect, but I love the variety, and I loved what you talked about. It was very informative.
Good. We love what we do. So
Thank you.
Thank you.
You can tell. Okay, take care. Bye, everybody. Thanks for joining us.